All right, we are live. So, welcome everyone to our first online value add webinar of 2026. We are thrilled to be bringing you one of the key partners for Hearthfire and all that we do on the investment side. Patrick Olerich with CohnReznick. They've been our tax firm now for going on 2 years. A very large firm. Patrick, how large is Cohn in the grand scheme of pecking order?
We're about 15th right now in largest accounting firms in the country. 32 offices, about 4,200 employees, and we'll do somewhere like around $1.2 billion of revenue.
Okay, decent size there. We've got so Patrick is joining us from Chicagoland, Jordan from Florida, and here in our office here in Berwyn. I'm going to kick this off by just asking where people are from, what brings them to this conversation, and if there's anything that anybody wants to see us covered. We've got a great agenda, which Jordan will talk about in a minute. So just to give us a little bit of engagement, share whatever you'd like, and we're going to go ahead and get started. So first, a little bit about Hearthfire. So for those of you that may not be familiar with our firm, we've got over 100 years of experience in real estate and investments. Corinne and I started our firm back in 2012, investing in small multifamily real estate in the Philadelphia and surrounding area. We pivoted over to self-storage back in 2019 as we saw that there was a really strong opportunity to capture a tremendously growing investment strategy and asset class. Today, where we stand right now is we've got an elite team of leaders, including Jordan, who's a senior director of investor relations that's on this call. Including our team is Mike Marin, Pete McDaniel, and Steve Good. Collectively, it is a really strong team that is very experienced in building and growing many, not just self-storage, but investment platforms across the country. To date, we have over 265 active investors who manage over 50 million in equity. Of all of our exits historically, which there are 9, we've had a 75% reinvestment rate. We have quite a number of investors that are in multiple deals, which is always our best recommendation in the efforts to diversify. And across our exits, we've done over 25% average annual return to investors, and that's annually. Today, it's myself and Jordan. I've got over 30 years of experience across finance. I worked for the Federal Reserve for 22 years in technology and financial strategy. I worked supporting the U.S. Department of Treasury and have been growing and building Hearthfire ever since. Jordan, you want to say a quick word about yourself, a little bit about your background?
Yeah, absolutely. I've been in total real estate for about 20 years. On the self-storage commercial side, about 10 years, starting in brokerage and then acquisitions, and I've been on the capital raising investor side for the past 6 years or so. I've had a lot of experience in storage, and storage is my favorite asset class by far, which is why I work in it.
Yeah. Cool. So our platform, we are in 10 states. We have 24 assets in various stages of stabilization, over 10,000 units, over 1 million net rentable square feet, and our property managers are Extra Space and CubeSmart. So you really are getting an institutional level platform when you partner with us. This is a little bit about where our investor sentiment stands. We ran a poll late last year, had excellent participation across our investor base, and you can see that where we stand out amongst our peers is around communication and transparency, deal access and quality. We take pride in providing institutional level investment opportunities to everyday investors, as well as a lot of joint ventures, operational execution, and investor values alignment. it's worth highlighting that partnering with a firm like CohnReznick really goes towards making sure that we have the foremost expertise in all things related to what we do. Two investment strategies that we are focused on today: income strategies, which are private credit and preferred equity investments. This is the largest and fastest growing investment strategy in the institutional world and beyond. This is capitalizing on the higher interest rates in the market over the last couple of years. Our funds offer 7 to 11% plus target fixed rate of return with priority positioning in the capital stack, 6 to 36 month commitment period. Our growth strategies are direct ownership investments in common equity across individual investments and various funds. Our target annual rate of return, internal rate of return, is 17 to 23%. And then this is where investors participate in the complete upside as well as operational cash flow as we execute on business plans. The typical hold period is 4 to 6 years. I'm going to kick it over to Jordan. He's going to introduce our speaker. Patrick's going to give a little bit about himself, and we're going to take it away. Logistic-wise, this is being recorded. The recording will be shared immediately after. We will be making the deck available as well. Stick to the end, and we're going to have a way for you to be able to contact Patrick for any tax questions that may be lingering, and provide some access, as well as a way for us to get together and speak on the investment side. So beyond that, Jordan, I'm going to let you take it away.
Thanks, Sergio. So today we have Patrick Olerich here from CohnReznick, who we were speaking to just earlier, but Patrick is our in-house expert who we've been using almost 2 years. He supports our business and our growth and is always here for us to answer any questions and to provide us additional value. Their company, as he mentioned, is one of the top 15 in the country, and they specialize in handling real estate and private equity companies like ourselves. They also do individuals, and they'd be happy to speak to anyone on this call as well. Today, Patrick's going to be going through the following agenda, starting with the current tax landscape and any changes going in the last year and into 2026. Then he's going to go into ordinary versus capital gains and how certain parts of our business are taxed, followed by depreciation and timing and how that cost segregation applies to some of our investment opportunities. And then into 1031s and how to roll some sale proceeds into one of our investments and other commercial development investments and commercial properties, followed by opportunity zones, and then some portfolio level coordination. So without further ado, I will kick off Patrick, and we'll be here throughout the way.
Thanks, Jordan. Appreciate it. Yeah, as mentioned, I'm Patrick Olerich. I'm a tax partner at CohnReznick. I specialize in commercial real estate and all things flow through taxation. CohnReznick, real estate is by far our largest industry overall. I think, between different types of industry or real estate groups, we'll do about 40 to 50% of our revenue as a firm in real estate. We have a deep bench in terms of, providing services that touch every different area of real estate. So if anything comes up, either I can handle it directly or we have great experts in-house who do. So let me take it away. The first thing we want to cover is the current tax landscape. I'm sure people have heard a lot about the new Trump tax bill, the one big beautiful bill. A lot of it was some rinse and repeat from the original Tax Cuts and Jobs Act back in 2018. But some key changes that are quite favorable. The biggest being that 100% bonus has been reinstated and revived. The Tax Cuts and Jobs Act had initially set for bonus depreciation to begin to sunset. It actually began to sunset in 2022. It went from 80%, 60%. 25 wasn't going to be 40%, 20% in 2026, and then eliminated from the tax code altogether in 2027 beyond. The One Big Beautiful Bill reinstated it to 100% permanently. That is very good news for the real estate industry, and a tool we're really looking to use. Now, with all good things, there's a few negative things. We are in what's called a transition period from an old set of laws to a new set of laws, and a few things that I think we just want to make sure that people are aware of. It applies to eligible property acquired and placed after service after January 9th, 2025. There are transitional rules as to how to determine that. We will cover that now. So the big things being the acquisition date, or whether it's self-constructed property. For acquisitions, the dates you're going to look at are actually when you entered a written and binding contract, not when you closed on the property, right? So something people should really be considering: if you went under contract in 2024 and you didn't close until after January 9th, 2025, you're actually still in 40% bonus because the old rules apply, and not 100% bonus. There's different rules that may be applicable on when a contract becomes written and binding. Generally, when it goes hard and deposits are made is one test we'll look at. If you have any specific deals, you want somebody to look at, we're happy to look into those things and just, determine, when that magic date would be. And then the second is self-constructed property. It's like, well, when did I really acquire this property? A lot of people would look at a place in service date when it became available for rent use. That's not actually how the rules are written. It generally has to do with when construction began. And it's a very small test for 10% of your hard construction costs incurred. It's not planning, financing, or site clearing. It's 10% of the actual hard costs of the new development going up is your testing date. Sworn contractor draw statements are a great source of evidence for where you're at in terms of percentage of completion on January 9th. But something we really want to give a lot of scrutiny to in this year entirely. I would assume by the time we advance further into 2026, most of these rules will be behind us in the past. And we're really just going to be considering 100% bonus, but just want to make everybody aware that it does exist in the current landscape. So no one gets too ambitious thinking they're entitled to all this bonus. And it turns out, all these other rules apply and you're actually entitled to 40% bonus, not 100%. We'll cover it later, but just want to mention the other big opportunity that the One Big Beautiful Bill presented was the reinstatement of an opportunity zone program, and I think that can be a powerful tool for real estate investors. But we'll cover that later. But just want to mention that is also part of the current tax landscape that the One Big Beautiful Bill added back in. Okay. Planning implications. We really just want to make sure we're getting into the nuances of what bonus percentages apply. Can we apply cost segregations? When you do cost segregations, it actually gets even more nuanced than that. I like to use a multifamily housing development, for example, where, let's say it's a self-constructed asset, multifamily, we're far beyond 10% on January 9th. So we think it's 100% bonus. But sometimes we can dig into those numbers and we can find that like the appliance package, to fit all the units wasn't actually purchased until, significantly later and wasn't part of the original contract. You're buying that separately, right? So you could be in a position where your appliance package purchased later is 100% bonus. And, your earlier self-constructed portion of the asset's 40% bonus. We can still really deliver results, right? And that's where the cost segregation studies really dive into those different components. They'll utilize what's actually part of contracts with the self-construction versus contracts to purchase separate FF&E, outside of that original contract. All right, income characterization, huge area to look at. How are we earning our income and how is it characterized, right? So when we get into the ordinary income versus capital gains. The general goal, I would say, of real estate investing is to target the capital gains. So, a great real estate deal gets into a position where we can structure it in a way that it's cash flow positive. We're able to return some cash, but after considering depreciation deductions, it's tax negative, and we're actually, building passive losses, that could be used elsewhere, right? So your ordinary income is going to break down into your buckets of your rental income, whether it could be income or loss, short-term capital gains, some recapture of depreciation. So depreciation, recapture of personal property. It's going to be your shortest life assets, 5 years and less. That's going to be at ordinary rates, which would be your marginal tax rate. We usually just say 37%, but if you're in a lower marginal tax bracket, it's whatever your rate is. Or it could be 25% if it's recapture on the building asset altogether. So you have your personal property bucket, that's recaptured at ordinary rates. The building itself, the real property assets, that's going to be recaptured at 25% rates. So there, you could actually have some delta there where your recapture is at a better rate than your ordinary. And then you have your capital gains, right? That's going to be your sale of the long-term held assets. Generally over 1 year. There could be some other, holding period considerations where 3 years, should be considered. That's, probably a little bit more nuanced than what we need to be talking about. And it's often tied to disposition timing and how long did you hold it for? The general idea is we have this business use asset of a real estate asset. We're going to depreciate it as much as we can in the early years, take losses to be used against it, and we can get to a position where ideally we're cash flow positive and no one's paying tax on those distributions out. Distributions in its entirety are tax-free events from a partnership. So you look at the actual profit and loss of the partnership as a whole, and then you look at the distribution second. So if you can get to the place where we're using these strategies to drive greater depreciation deductions, you could get a cash on cash return without picking up any ordinary income. And then on the back end, you sell it, create capital gains, and your entirety of your income tax is paid at ideally a 25 or 20% rate instead of a 37% ordinary rate as you go. I think that's one of the most powerful tools of real estate investing. Since we're talking about it, depreciation and timing, how cost segregations influence tax outcomes. The idea of cost segregation is essentially you have, all these different components that make up an acquired real estate asset. You have your roof, the core and shell of the building, foundation, land improvements, parking lots, roads. It's like, well, what are the depreciable lives of those, right? And the one big beautiful bill simplified the asset classification and what's entitled to bonus. Actually, I'm sorry, the Tax Cuts and Jobs Act simplified what's entitled to bonus to being anything that's 20 years or less of a recovery period, right? So what does that allow us to do? It allows us to look at our land improvements that are 15-year depreciable assets. Those now become bonus eligible. All of our FF&E, personal property, et cetera, those are all bonus eligible because those are 5, 7, or 9-year property. And then there's another component that I think people miss and is very challenging to find without a cost segregation study. And that's the fact that the IRS allows electrical or other types of system used to power FF&E as also being FF&E themselves, right? So in the context of a restaurant, for example, your grill equipment itself is FF&E, it's personal property, it's generally movable, you can pick it up, you can move it to a new restaurant if you had to. Well, all of the electrical that you put in specifically to power that unit now becomes also bonus eligible FF&E, where electrical systems are generally building components and would be depreciated either over 30 years or 40 years. And that's a very powerful tool. It takes an engineering study to really go into blueprints and designs to figure out what are those short life assets? And it becomes significantly more powerful than maybe just looking at a contractor draw statement and saying, okay, we paid for a new fridge, we paid for a new grill, here's our F&E. No, we're grabbing a lot of building components that would otherwise be depreciated over 39 years, and we're moving those to 5-year property. And now with the One Big Beautiful Bill, that all becomes immediately expensed in year one. Incredibly powerful tool. A lot of real estate investors are going to be subject to what's called the passive activity limitations. So your losses are generally only deductible to the extent in which you have passive income. It's at an aggregation level amongst all passive activities of a taxpayer. So the more we can accelerate into the first year, even if some of it ends up as a disallowed loss for passive activity limitations, you now have this carry forward that can be used against all other forms of passive income, right? So even if you have a second investment that's considered passive, maybe it's not even real estate, these real estate losses can offset it, right? And that's going to be year 1, year 2, year 3, right? Until it's completely disposed of. Worst case scenario, you don't generate any passive losses, and these passive losses reduce, income in years of gains, right? But that's a pretty rare situation. I think most people who are invested in these types of things, have a number of passive investments. So the more we can drive forward in year 1, not only does it, reduce the tax impact of the specific deal that cost segregated their asset, but it could also yield very powerful results across an investor's entire passive portfolio.
Patrick, real quick, is there a time limit at which the carry forward expires? Is it when the deal ends? If it's a 5-year hold period, is just go forward until it's used?
It's go forward until it's used. They put some limitations, I believe, in NOL carry forwards, but passive activity limitation should not be. There is a special caveat that if a deal goes final, if all of the passive losses have been used, it becomes freed, and then it can be used against ordinary income of either investment or earned. The tax code essentially breaks income down into like 3 buckets. Earned, which would be anything that you're active in, your W-2, your wages. Investment, that's going to be your interest, dividends, stock gains. And then passive investments, that's going to be your real estate investment. So you can't use passive losses against all those things unless an activity goes final and is disposed of without having been used. But they don't expire. They can only become used earlier if it makes sense given the situation.
Thank you.
I want to keep things moving. Deferral strategies. So, I think the most tried and true strategy that most people have probably heard about is 1031. That's going to be your like-kind exchange. It's going to be taking like-kind property for like-kind property. The Tax Cuts and Jobs Act significantly reduced that down to being only real property that qualifies. It used to be other forms of personal property that qualify. But they left it in for real property. Great news for real estate investors. They can continue to take advantage of it. Essentially, you sell an asset and you need to buy an asset of the same size or larger. I think that's an important caveat for everybody. If you take any cash out or you reduce your overall debt load, that would be what the IRS refers to as boot. And boot is an economic event that is beneficial to a taxpayer and therefore should be subject to gain, right? So even if I take all of my cash and I reinvest it in a new property, if I buy a smaller property and I go from say 5 million of debt to 4 million of debt, the IRS does consider that, an economic gain that I no longer have this debt outstanding and it becomes boot. But so long as you put all your cash back in, you send it to a qualified intermediary, they reinvest it, you buy a new property, use the same debt, all of the gain carries over as deferred, none of it's recognized, and you can continue on investing, right? Anytime you look at compounding gains or income overall, it's always significantly better to reinvest, right? I have $1 million sale. It's $1 million, just call it all of it's $1 million of gain. You have two options. Do I roll it over and defer it? Or do I take and pay the tax on it? Well, if you take and pay the tax on it, you're going to pay 20%. Now you have $800,000 to reinvest versus your other investment that's back in at $1 million. It's going to continue to compound, right? So the math always works out in the favor of deferring where possible.
Hey, Patrick, real quick question. This comes up, and I actually included this in the question section, but I'm going to ask it now. If you take the boot, can you then acquire, and you have enough time left in the year, acquire another investment, say that is you get a cost segregation study that includes a bunch of other losses? Can it offset the gains from the other investment?
Yes. So if you cash out some, right, and then you take that cash and buy another real estate asset, you can cost segregate that real estate asset. It would be passive. So the gain on the sale, so long as it was a business use asset, would be a passive gain, not an investment gain, because the gain is from the sale of the asset. There can be some nuances there to the asset type and the gain type, but generally speaking, the boot itself would be passive. And if you invest over here into a cost segregated asset, you could use those losses to offset your boot. Absolutely doable. I would just keep in mind that as soon as you have funds released from a qualified intermediary, it is going to be boot. Like, even if you think you go and buy another real estate asset and it might be a continuation of the 1031, it's not. You can't have control of the funds. That's really why the qualified intermediary exists, to bridge the gap between when you sell it and when you acquire it. So there's one continuation in which you've never controlled the cash or the asset. But if those periods lapse, maybe you didn't identify enough properties, or you only closed on one of your identified properties and you're left with some boot, investing it elsewhere in something that's going to generate significant year one losses would absolutely reduce that tax burden on the boot. In some cases, almost entirely, right? When you look at, debt levered real estate, on some of these cost segregation studies, we can get 25% pending asset class in year one upfront depreciation. If you think about, your debt to equity ratios and maybe your 35 to 40% equity, over in the asset as a whole, you're almost returning the entire capital account in year one in depreciation deductions. Right.
Yeah, we've actually, we got a couple of cost segregation studies done for some assets that actually a couple still have some limited shares available, that the cost segregation studies are 40+% losses. And I ran into this myself. I talk to investors regularly that are trying to do a 1031 exchange with a very small amount of gains, and by the time you find that property to trade in, you're almost being forced to buy something that you probably don't want or shouldn't, because the economics just aren't there, the value just isn't there. So I advise, consider taking the boot and then finding another investment within the timeline, a different timeline, to be able to capture those losses. So I'm glad you were able to confirm that's factual.
Yep, absolutely. And the 1031 rules say you have to acquire real property for real property. So you sell a building and you have to buy a building. You can't enter a new partnership. So if you're looking, I guess in Melissa's scenario, you're looking to divest what would be, a more active portfolio and enter a more passive portfolio, 1031 can be incredibly challenging, because you're still supposed to maintain and own those building assets. There's tools that can be used, tenants and commons, Delaware statutory trusts, but often you find, those are limited in options in comparison to, passive real estate vehicle partnerships funds that exist. So really looking at what those funds are going to return to you in depreciation and other items in year one to help offset your gains versus truly deferring them, I think is incredibly important to look at, because it allows you to move more into a passive landscape than, continuing to own real estate directly yourselves. Let's keep things moving a little bit. I know there's a lot of good stuff to cover here. Okay, opportunity zones, another great option for when we're looking at gains. The opportunity zone program is effectively, you have the qualified opportunity zone fund that's going to pool everyone's money together, and then the opportunity zone fund is going to buy qualified opportunity zone businesses. That's going to be your real estate assets physically located in a qualified opportunity zone. Those zones are designated by the government. It was reinvigorated, if you will, in the One Big Beautiful Bill and made permanent. So this is now going to be every 10 years, they're going to name new zones. And essentially, you buy an asset in the real estate zone, you either self-construct it or you substantially improve it. So I buy a plot of land, I build a building, it now becomes a qualified asset. Or I buy an existing building and I follow the substantial improvement tests and I increase the basis and the value of that building, it's now a qualified asset. So how does the program work? Essentially what an investor does is they take dollar for dollar and they put it into the fund and they get gain deferral, right? So if you have $1 million of gain, you put $1 million in the fund, the full $1 million is deferred. Over 7 years, you have this deferral. In year 7, you are going to have what's called a gain recognition event, and you are going to pay tax on your gain. After year 5, they're going to give you a 10% step up. And after year 7, they're going to give you a 5% step up. So you end up paying about 85% of your capital gain at year 7. And then if you hold it all the way until year 10, no gains on the back end apply. Now that's incredibly important because the gains that are eliminated as part of the opportunity zone program includes depreciation recapture, right? So it's not only the appreciation of the property, it's also not recapturing the depreciation. So what can we do? Well, as we've talked on other things, we can buy an asset and we can cost segregate it and we can depreciate it as much as we are allowed. We can generate substantial losses, and then they could be carried forward as a passive activity limitation. Maybe you're using them against other sources of passive activity, or maybe you're carrying them all the way forward until your year 7 gain recognition event. And when you actually do your tax return and you have some of these gains coming through and you have these other passive losses, maybe you don't actually pay any tax after year 7. And then you hold it for 10 years and you don't pay any appreciation, or you don't pay any tax on all of that depreciation over the years. So it's entirely possible if you go into this with a gain deferral through a number of strategies, you may pay little to no tax at all ever on the investment. Now, again, a number of things have to happen. It's extremely nuanced. If it is possible that in year 7, if your gains are from a large stock portfolio, it's going to be investment in nature, and we would have to look at whether or not your passive losses can be used against that. So there's a lot of matching here. It's extremely nuanced. This isn't specific tax advice other than this program exists, and there are tools within it that can be incredibly powerful. But every situation is unique. Every situation is nuanced. Let's have those conversations and see where it makes sense. But now that they've made the program permanent and they've done these things on a rolling basis, I think it's really something people should take a hard look at if they're sitting at, deferring gains and like a deal and pending where it's located. Just really wanted to make sure we had a chance to discuss that. Could be incredibly powerful on the back end to eliminate those gains. Portfolio level coordination. All right. I also think this is something that is incredibly important. As part of the Tax Cuts and Jobs Act, they eliminated what used to be called carrybacks of losses, right? So if you had a bunch of losses in a year, you could theoretically carry it back 2 or 3 years pending the situation. So, if I had losses in 2025, I could carry back to 24 or 23 in years I may have paid tax, or elect to carry it forward pending the situation. They eliminated that, right? So what does that mean? It means you need to coordinate to make sure that you have the appropriate deal flow and that your portfolio in years of gains and income has sufficient losses to offset it in those years. Gains tomorrow or losses tomorrow, if I'm like, oh, wow, look at this big gain I have in 25, let me invest it in 26, it's going to be incredibly challenging to carry that gain back. I mean, not challenging, it's not possible any longer, to 25 where it used to be, right? So now we need to make sure that you're aligning across an integrated portfolio depreciation deductions in years where you have gains, right? So we want to make sure we're on top of deal flow, making sure that, like, as you're exiting one thing, if you don't want to just walk away and pay the tax on it, that you're entering something new that's going to look at either one of the deferral techniques, 1031 opportunity zone, or they're pursuing cost segregation strategies that are going to accelerate those deductions into year one, to make sure that you're not overly exposed to the gain that happened, right? It's proactive versus reactive on an isolated deal level. And you're really just more focused on one at a time and the next. But when you have an integrated portfolio, you can time those things. There's also some limitations on the amount of NOL that can be used in each year. Your NOL is limited to 80% of your taxable income, so you could be left with a tax bleed there if you don't match the years in which the NOL is incurred versus the year the income is incurred again. So these are all really portfolio level decisions that should be made. Now, you have to really think through them with your own personal tax advisor, right? We would have no way of knowing what everyone's, passive activity situation is, how they're reporting it. Are they considering themselves a real estate professional? There's a lot of nuance individually within the tax code, but the more you work with, a group such as Hearthfire and making sure that you're really coordinating on a portfolio level, they'll make sure that they're acquiring enough properties annually to be, giving returns and losses against other gains. And that's the huge benefit there of really looking at it as an integrated portfolio strategy and not isolated deals, because you could leave yourself exposed where you have gains in one year and a lot more tax leakage than you expected because you didn't get into the next deal till a substantial period of time later. All right, and that is what I had to cover. There was some questions in the chat. Jordan, I don't know if you want to talk about any of the Hearthfire stuff while I catch up on the chat questions, and then maybe I can revisit a few things at the end.
Sounds good. So continuing the conversation, Hearthfire offers both direct investment into individual deals and then our private credit strategy, as Sergio outlined before. On the private credit side, you could invest in our income fund, which is a debt vehicle that lends to other self-storage owners, operators, and sponsors. We come in at the senior debt level, mezz debt, preferred equity, etc. That is a evergreen fund where we are accepting money every month, and that gets paid out monthly from 7 to 11% annual returns. And then we have preferred equity investments in specific opportunities that we do, which we have one coming up in Hudson, Florida, which we'll get into in a minute. So that's our income side of our business and the private credit side. And then on our growth side, we do acquisitions and developments of self-storage projects, and we're pretty active. So 24 projects over 10 states over about 7 years. And this year, our goal is to do about 6 of them. So, if you're interested in learning more about what we have to offer now and what's on the horizon, we love to continue the conversation after the call.
Yeah, one other thing to add to that is going back to what Patrick alluded to, is one of the areas that we've started to build a specialty in is custom strategies. So Jordan mentioned our income focused and growth investment strategies. We've now developed models where we can create hybrid strategies that both take the income side and the growth side give you the tax losses on one side, on the equity investments, while also amplifying your passive income. So we're able to create those custom strategies while also evaluate what you can do tax wise as well. We're going to pop up a couple of things on the screen here. One of which is going to be a way to contact Patrick as well, and then also booking a call with our team if you want to explore any of these. While this is going on, Patrick, go ahead and hammer at the questions.
Yeah,
and if you have any other questions, by all means, add them in the chat or the questions. If it's something that you really want, we can also bring you onto the stage. If you wanted to talk about it live, we can do that as well.
Yeah, I think Melissa had a couple. I think it can be challenging. I'll start with the first about single family homes, about 50,000 of equity in each. I think in investing your income and cash from that with somebody who can return, like Sergio said, 40% in year one in deductions is going to significantly, reduce that burden and get you into a strategy that is more aligned with the passive losses you're looking at going forward. Maybe year one, to offset those things is a little bit more of the loss drivers. And then, you start to pivot into maybe the income drivers thereafter. We match it, like Sergio said. I think that's a really good nuanced example of where, your individual needs in deductions versus timing of income. I think there's a lot that can be done there, but that gets very, very individualized and personal on all of those things. What are some strategies to keep this from catching up with you? Again, I think that goes back to the integrated portfolio to make sure that you're investing in a way that, is consistently looking at deal flow and turnover and making sure that gains are being taken off the table at points in time, and new cost segregation and depreciations are being driven at the same point in time. So at no one point in time have you incurred too much tax or have too much tax exposure on, significantly reduced bases. It's really, an ongoing strategy and mitigating it as a portfolio as a whole. How would this apply to gains one might receive through investing in something like what Sergio and his wife offer? I think that question came in towards the end when I was talking about opportunity zones. Opportunity zones have a 180-day window to invest from a gain event. So if you sell stock, say I sell it today on 2/11, I'd have 180 days to invest. I can take that, I can put it whatever. The interesting thing is that if you have investments like Hearthfire, you actually get multiple periods you can consider, right? The first period being the date the asset sold, right? A lot of times an asset sells, a distribution is made, you get cash. You can use that date for your beginning of your 180 days to go reinvest it. The second date you can use is the end of the tax year, and you can call it 12/31, and you can invest all the way to call it June 30th. I think on a strict 180-day count, it might end up like June 28th or 29th. But or the most powerful tool is you can actually use, if a gain is passed to you on a K1, you can do the original due date of that tax return. Partnerships are generally due 3/15 unless it's a short year final return or something unique that would change it. But that gives you from 3/15 to 9/15 all the way to September of the next year to decide to do something, right? So you're invested in Hearthfire, there's a big gain. It sells in 2026, maybe the entity, continues ongoing through, some final windup costs, whatever. And, it's a 12/31/2026 tax year. You can either choose 2/11, the date the asset sold, 12/31, the end of the tax year, or you can extend that date all the way out to March 15th, 2027 to make that 180-day investment period. So you can kind of wait to see what your whole portfolio looks like, what your tax year is going to look like. am I left with net taxable income? Do I have enough passive losses to offset it? And then if you have gains, you can go back and say, okay, even in June of the following year, hey, I'm gonna find an opportunity zone fund and I'm gonna invest it in there, right? So I think that's one of the incredibly powerful ways that the opportunity zone program can be used, a little bit retroactive instead of always needing to be prospective with some of the tax planning.
And does that apply to opportunity zones in addition to 1031s, or just opportunity zones?
That's opportunity zones. 1031s, you have 180 days from the date of sale to replace it. You technically can't be past a gain that's deferred on a K1 in a 1031 because you need the partnership that sold the property needs to be the one who replaces it. Where you can be, the gain can get passed all the way out to the individual and then they defer it later in an opportunity zone. Another powerful tool of why opportunity zone makes some sense. Now, just a quick challenge with an opportunity zone. I know Melissa's asked some questions here about, heavily depreciated assets. It is dollar for dollar reduction of gain. I have $1 million gain. I need to defer it. And a lot of our 1031s, we may have extremely low basis assets, things we've taken a lot of depreciation on, where maybe the gain's greater than our cash, right? We're going to cash out $1 million, but we've taken a ton of deductions against it. Our gain's 1.5. All we need to do is reinvest that $1 million plus the debt, and we can defer the whole $1.5 million of gain. So that's where 1031 can be more powerful than opportunity zone. And you can defer more gain than necessarily cash, right? Where that same situation, if I just get my $1 million back out, but have $1.5 million of gain, I'd have to come up with either more cash to defer all of it or pay some tax on it. So it's not there. There's problems with each, right? Because 1031 doesn't have total gain deferral after 10 years. So that is kicking the can down the road a little bit more. So, but it can be a little bit more powerful in our very low basis assets. Looks like Richard, your question was answered by Sergio. Melissa, so we made money on the sale and investment with Hearthfire and reinvest into their next investment. Would that defer the taxes? I mean, it's an incredibly nuanced question to ask. I think Hearthfire is, considered opportunity zone deals, and it may or may not, depending on the deal structure. I mean, not every deal that you invest in is going to be an opportunity zone. It has to be real estate located in a specific area, set up a certain way. But having said that, it is entirely possible that the reinvestment into their next investment returns enough depreciation deductions that also offsets the gain, right? So that's where maybe through these depreciation deductions, we don't even have to look at these more regimented, nuanced programs. We can look to traditional benefits like cost segregation that are, a little bit easier to facilitate.
Hey, Patrick, I got a question that I posted in the questions. In the electrical wiring nuance that you mentioned with the FFE example, is that typically surfaced in normal cost segregation studies, or do you need the separate engineering study that you mentioned?
A high quality cost segregation study should include the engineering component. Okay. I mentioned high quality because there are people who do lower level studies. Maybe they don't think that there's a lot of electrical wiring to be captured, and the net value of, obviously with a full engineering study, there's an increased cost to the cost segregation study itself. And if there's not a whole lot of assets to capture there, it may be not, scoped appropriately. So, but the highest quality cost segregation studies, I'd give a shout to our cost segregation specialist, Derek Weaver. If you're interested, I can put you in touch with him. We have 20 engineers on staff here at CohnReznick that really break down these engineering components of a cost segregation study. Derek sits on, the national board for cost segregation professionals. It's really doing things the right way in all of those things. There's providers in the space that, want to help you do a little bit more asset allocation, based on easy to determine things and aren't really getting into that engineering nuance. But yes, a high quality asset cost segregation study will always include an engineering component that captures those items.
All right, cool. Thank you. All right, some other questions in here from Sarah. So if I have a 1031 exchange of 1.2 million and invested in an opportunity zone, the capital gains would go away over 10 years. I wouldn't have to wait till I died to pay the taxes on gains.
There is this 7-year gain recognition event where you would have to pay the gains on that exists. So on your tax return after 7 years, you are going to report a gain of the amount invested in it, less these step ups they're going to give you, right? So your basis gets to increase against that gain, and some gets eliminated. So you will pay tax on that, right? The question becomes, can we generate other losses that can be used against it through the life of the deal up to year 7 to mitigate that tax impact is another planning strategy. But I don't want to say that you're not going to pay any capital gains on it, because that becomes facts and circumstances of performance in deals, how things have gone, individual circumstances. There is that year 7 event, but anything from there on is eliminated, and you don't have to wait until you die.
Great. What other questions do we have? There's another question that I believe was already answered, which is when we often get investors that are looking to offset or do a 1031 and gains that are less than, say, 250,000, and know that the administrative part of, say, doing a 1031 exchange into a tenant in common situation, where we've done that quite a number of times, when it's less than a certain dollar amount, the brain damage that Patrick goes through with the taxes for a small amount is, we typically have a minimum where we say it's not worth the administration. So in some cases, that's where it's easier to, or it's worth considering taking your gains, as Patrick said, and then finding another investment to offset those gains in the same year, right?
Exactly. And there's even more considerations that lenders can be challenging with tenants in commons that facilitate 1031s. I think when you look at overall small tax deferrals versus the administrative costs that, become increased because of it, I think a lot of people would see on the return, it's likely, not worth it. And, to look at some of these other strategies of, significantly increasing losses.
So it looks like, okay, what is here's a question from Richard. What is the minimum amount you generally do for your TIC transactions? 500,000 is kind of where we found to kind of be the sweet spot, where it doesn't get us into, the administrative cost is not, outweighs is not as impactful. And then there's a top end of the 1031 exchange or the TIC as well, where you get into some of the legal or the lender questions, where you become a 25% or greater owner. Then it changes a little bit the nature of the investment in the eyes of the lender. Then you might be subject to, guarantees and that kind of thing. And that's where we like to kind of ensure that investors are truly more passive. On the screen is the landing pages for our income fund and our Whitehall investment opportunity that still has very limited shares. When you go onto those pages, you'll also see that you're able to browse our overall investment strategies and also see an intro to our upcoming investment in Hudson, which is what Jordan is sharing here. Go ahead and scan the QR codes. We'll pop up again the ability to schedule a call, and then also make sure that you can reach out to Patrick. Patrick, any other thoughts or words of wisdom? Here we are in February. I like to do my tax planning for the year early in the year, and then think about it later in the year. I'm always a proponent of filing an extension just to make sure that I've got all my eggs in a basket. Give us some general thoughts on how people should be thinking about their tax strategies right now and through the rest of the year.
Yeah, absolutely. A big component of that is going to be, like you said, starting early in the year. It can be challenging to find deals to invest into on a small, tight time horizon. When we look at our easiest strategies of loss drivers for passive losses, that's going to require an investment into some sort of partnership that's beginning. Hearthfire may have something that still has spots available, but generally it's challenging to return losses on investments made after the year closes. I mean, generally not allowed. So the more lead time you give yourself to get into some of these deals and mitigate things throughout the year, make sure you're in advance of transactions. And then, like Sergio said, I think extensions are a powerful tool. Like we sort of walked through the Opportunity Zone program. You can extend some things well into the summer. But obviously, it has to be, you can't file your return reporting all of it first and then go back and defer it, right? So if you have these time periods on your horizon, it's not a bad idea to keep that in your back pocket. To say, maybe you have a gain. You're not really sure if you found a deal you like or not, but maybe something pops up in June. It's like, hey, all right, this is a great looking IRR and an Opportunity Zone deal. Let's structure it appropriately. And that gain I had, from this deal with this other operator, now I can go back and defer it. That adds some legitimacy to that. So overall, early and often, and then giving yourself time at the end of the year to work through things. Obviously, payments are due 4/15, so the extension doesn't give you an extension of time to pay, but it gives you some time to figure out if maybe you want to go back. Right? You pay the tax, you go back and decide to defer it. You file and request a refund, and you get your refund back. Right? So it's you leave that card in your back pocket for when you want to play it. And I think that's an incredibly powerful tool to use.
I got one last question. I know that we're just about out of time, and appreciate everybody for hanging with us. Again, the recording will be sent out. On screen, you're seeing a link to our upcoming events, both online and live. We've got a bit of a road show that we're doing. Jordan and I will be in Miami. We've got an event in Philly next week, and then we're going to be in San Antonio, Austin area in March as well. So we'd love to continue and connect with everyone. Patrick, any thoughts and recommendations as it relates to individuals kind of building their tax team, like what to look for in a tax pro that really understands all of these nuances, or should they just, contact Cohn?
We're not going to be the right fit for everybody. Not everybody wants a big firm. As much as I'd love to say, we have people who handle a lot of different things. Some people just like their local connection. We're national. We work across national groups. Obviously, I'm in Chicago. I work with Hearthfire in Pennsylvania. Jordan's in Florida. Some people just want, the person that they can go see down the street, right? And I get that. So I don't, it's not a hard pitch necessarily on us. Everybody just has a trust level with their advisor. And sometimes that does become a personal local relationship. Fine. You gotta really, make sure they understand the passive activity rules, when losses are allowed, what can be used against it. State reporting rules in terms of like PTET deductions. It's something we didn't even get into today, but something that, people should look at. Make sure they understand the nuances of where may need to be filed, and that, you can use state taxes paid in a different state for a credit for taxes paid to another state, right? So you're a Pennsylvania resident, maybe there's some Indiana tax. You can take a credit for taxes paid in Pennsylvania for your Indiana. So I think those are the two biggest components that an advisor should know how to do. is really aggregate your passive activities, drive as much benefit as they can on the law side, and then understand your state filing requirements. When you look at a real estate portfolio, if you're looking in a small local area around you, you're probably not going to find as much benefit as somebody who's willing to look around the country for the best deals. That may pose some state tax challenges, but generally most of the state tax burden is taken on by the partnership and to pay any required taxes, and the individual just needs to file. Often cases, right, you have one deal in Indiana that sells, has a gain. Maybe there's some taxes paid on your behalf by the partnership, mandated non-resident withholding. And then you have another deal in Indiana that's passing losses. Well, you can use that losses against that withholding. You just get it refunded, right? Great. You got to make sure your tax advisor understands that they should file that state. They should use all the losses located in that state to request a refund in that state. And if there's any residual tax to be paid, that they're then using that as a credit for taxes paid against in your home state. So if you can find an advisor who can speak well about those two things and understand those nuances, they can generally handle most of this. If not, we have great people at Cohn who can handle it. Myself, I don't do many individuals, but we have great people who do. It's not going to necessarily be the person down the street from you. They'd love to talk to you on the phone, have a personal relationship. It's not to say we won't be personal, but it's not, I have a lady, Tracy in Boston, who's an incredible, individual person, right? Well, if you're not in Boston, it's gonna be difficult to show up and go talk to Tracy, right? Like some people want to, but can certainly connect you. And if you're comfortable with like that remote aspect, right? So we can do great at it. If not, I understand people's, considerations of wanting their local person, and that's what you should look for.
All right, cool. Hey, we're out of time. Thank you so much, Patrick. This was awesome. Got great feedback. Looking forward to the next one, and wishing everybody a great rest of the week. And launching.
Thanks for having me, Sergio. Appreciate the time to talk about what we do and how we can help drive benefits. So appreciate that.
Yeah. Any parting words, Jordan?
No, thanks, guys. Appreciate it. Really helpful.
Talk to you soon. Thank you. Bye-bye.